Balance sheet is also called as statement of financial position.
Assets minus liabilities equals net assets is called as the balance sheet equation or the business equation. The income statement is a temporary account that will be closed at the end of the period by the transfer of its balance to the shareholders' equity and ultimately to the retained earnings account on the balance sheet. Revenue is an influx of economic resources for the firm. An expense is a consumption of resources. Two approaches for recording inventory are perpetual inventory system and periodic inventory system. Current ratio equals current assets divided by current liabilities. Long-term debt to equity ratio equals long-term debt divided by equity. ROE equals net income divided by average equity. The balance sheet is also called as the statement of financial position. Accrual accounting creates a timing difference between recognition of revenues or expenses and their cash implications. According to IAS 7, the statement of cash flows shall be classified by operating, investing, and financing activities. The left-hand side of a T account is called the debit side, and the right-hand side the credit side. Revenues increase shareholders' equity, but expenses reduces it. Current ratio equals current assets divided by current liabilities. Cash ratio equals cash plus marketable securities divided by current liabilities. Long-term debt to equity ratio equals long-term debt divided by equity. ROE equals net income divided by average equity. Return on assets equals net income divided by assets year 2 plus assets year 1, divided by 2. Inventory turnover ratio equals COGS divided by beginning inventory plus ending inventory, divided by 2.